15. I'm gonna go ahead and get started.
Okay.
Anytime anyone have any questions, you can always just either put the hand up on the bottom or you can just interject. And we're gonna go ahead and get started. If anybody want to introduce themselves, you're welcome to do that before we get started. If not, we will get started. Okay. All right. Well, I'm gonna go ahead and share the screen. Okay, so everybody can see that. It's the first slide of the brief. I just want to highlight C. What the objective is for today is to make sure that we all become knowledgeable about taxation, inflation, deflation, supply and demand, recession, depression, and interest rates. I know that's a lot, and I try to get through most of it. If I can't, then we're going to make sure that that we'll move it to a future class. I want to make sure that those topics are covered, and I want to make sure that you understand those in detail. That's kind of the key, and because all those topics affect your money as an investor. So I want to make sure we do that. As always, you're going to need your smartphone or computer. I send everybody out a copy of the tax rates. We're going to be doing a couple of PEs, practical exercises, so you can demonstrate your knowledge on how to calculate taxes. We're not talking about filling out a tax form. We're just talking about how to understand how the brackets work and what that means for you. Okay, and the app that we always use, if you're an iOS user, is the Stocks application, and if you are an Android user, it's called USA Stocks. A little Zoom etiquette, we just ask that you zoom all your, mute all your microphones when not in use, and then of course always silence any cell phones. Any questions about that? My top right, I always keep that in the box for when we start. You know, it is a Christian investment group, so our scripture verse is Proverbs 22:7. The rich rules over the poor, and the borrower is the slave to the lender. So basically, it simply means that the more that you borrow, the more you have to work to pay your bills. That's basically what it means. So that's why it's the borrower is the servant to the lender. This is some background so that everybody's same base on background. The purpose of taxes, of course, is to fund the government expenditures. And the key thing though here is it should fund things that we all benefit from, but few can pay for alone. With that in mind, will anybody kind of comment on some things that, one, you may feel is things that we should fund based upon the definition, and then things that we should not fund? Okay, kind of, was the question kind of clear? Anybody hear me? You got to unmute yourself if you want to speak.
Yeah, I can hear you.
Okay.
I can hear you.
Okay, so the question was, based upon the definition of the purpose of taxes, it should fund things that we all benefit from, but few can pay for alone. An example would be an armed forces. That would be something that the government funds that we all benefit from, but most people can't buy their own tank and aircraft carrier and things like that. So those are things that money should be used for by the government to fund. Can we think of anything else that falls in that category that we should all, that taxes should be used for, and then a few things that taxes should not be used for based upon the purpose and definition here? Okay, let's start with the ones that taxes should be used for. Again, using the armed forces as an example. What are other things that we all benefit from that generally not one person can afford by themselves? We're talking about the Gates and the Bezos. We're talking about the general middle class. What are some things that we all use that not one person can pay for? What about schools?
Roads.
Schools, okay. Schools would be one thing that most people use, benefit. Some people still homeschool, but the majority of people send their kids to public schools. That's something that we all use that not one person can afford. What else? I'm sorry.
Maintenance of our roads.
Roads,
Maintenance of
absolutely.
roads?
Roads, absolutely. Roads, things that we all use driving interstate from, California to New York, but not one person can afford to pay for all the roads by themselves. And so those are things that the government should be collecting taxes for. I'm trying to get a real good base to make sure that we all understand what it's really for. And then we can get an understanding for things that we should be supporting and not supporting based upon that. What are some things that do not fall within this definition that the government collect taxes for?
Schools.
Meaning that what's one thing that the government collect taxes for that people really can pay for themselves, that is not a collected use for it?
Can you hear me?
Yeah, I can hear you, Calvin.
Schools.
Well, school would fall within the definition of things that the government pay for that not one person can really pay for. Their own teacher, their own principal, their own
Property
building.
tax.
Huh?
Property tax.
Well, that's a different type. That's good. That's a different type, and we're gonna cover that later.
Okay.
That's a different tax, a different type of tax. But yeah, things that when you, how about a foreign aid? All right, foreign aid is something that, do they really fall within the scope of the purpose of taxes in this sense? You can probably make an argument there's a national security need, but there are the study of ants and stuff and things like that. The study of catfish in a pond, is that something that the government should be collecting our taxes for in order to pay for? And that's something that you got to make your own decision on. Again, this is just give you information based upon what it's for, and so you have an understanding that what it should be used for and what it should not be used for. Justification for taxes. Early taxes were used for the ruling class, people who had the power to raise armies and to build defenses. So you see common two of those things are always like raising armies and building defenses, but the ruling class collected money from the people for their own personal use. And of course, the Civil War, not Civil War, but the Revolutionary War was based upon taxation without representation. And so you can see how they were just collecting money basically for the monarch in Great Britain, but it was not used for the things here in the States. So that was the early justification of it. The history of it, you see here, the tax revenue allows the government to operate and provide goods and services for the citizens. And those goods and services include roads, bridges, national parks, education, research, and national defense. And that should go without question. Further down, though, in sub paragraph D, a public good are those things that are non-excludable and non-rival. Non-excludable things that is a supply of a good or a service that cannot keep people who don't pay for it from using. An example of that non-excludable would be things like the police force, the armed forces, the fire department. It's a good or a service that the government collects taxes for, but you cannot be excluded from using it. So if you use a category, we're going to cover later on, that didn't pay taxes, you can still call the police if you need them. Okay, so you're not excluded just because you don't pay any taxes, as an example. A non-rival will be a good or service that does not hinder anyone else from consuming it. And again, that would be if the population grows, everybody's still entitled to the same level of protection from the fire department or the police force. That's a kind of a good example. So that's a good, talking about background. For us here in the United States, Article 1, Section 8 of the Constitution is what gives Congress the power to lay and collect taxes, duties, imports, and excises. And the key here is to provide for the common defense and promote the general welfare. So that kind of gives you a background, the authority, where it comes from, and then what it should be used for. Provide for the common defense and promote the general welfare. Okay, so that's the key. Governments pay for the services they provide with revenue obtained through income, consumption, property. And I think Kelvin talked about earlier property taxes. That's a means of how they collect it, authority and the sources. And individual businesses are subject to taxes by the local, state, and the federal government. So normally you get hit by 3 or more jurisdictions when it comes to income tax. The federal government collects most of their taxes from income taxes. That goes without saying. That's why the IRS is so big on collecting the taxes. That's how the government gets its taxes. State government get their taxes from income taxes and also consumption taxes. So most states have a sales tax where that's how, between the income tax, state income taxes and the consumption tax, things that you buy, and that taxes are different per state, but we're gonna look at that later. So that's how the state get theirs. And I think Kelvin mentioned this earlier, local governments get their money strictly from property and wealth taxes, okay? So their property taxes is how local governments get their money. I know here in Waynesville, St. Robert area, everybody, if you own a home, you're gonna pay property tax. Or if you have a car, you're gonna pay some type of tax in your local jurisdiction. Any kind of questions, comments about authority and sources? Okay.
No.
Okay. This chart here shows the, when it gets to you, all right, these are income taxes by state, okay? And I just kind of want to highlight the highest rates in the nation. You see those on your left-hand side. And then you can find the state that you stay in and see. And then the one on the bottom in the gray are the states with lowest or no income tax rate. Not talking about sales tax, we're talking about income tax. So either they have a low or no tax rate. Is there anything that kind of jumps out at you as far as the individual income taxes? Okay, good. One thing you can kind of look at is states that have the highest rates normally have the biggest social safety nets, okay, social welfare, social safety nets. So you have to collect a lot of taxes in order to be able to provide those services. So it just only makes sense. And then of course the states that have the lowest or no rates, then they normally provide not as many social services for those states. And that's why it's good to have different states, because you can move to wherever you think provides you the best tax relief. So that's a good thing. Okay. So no questions?
No, sir.
Yeah.
Oh, you got it.
Hey,
Yeah,
can you go back?
Sure.
Yeah. So I was wondering, does anything have to do with being a republic state or red state or blue state with the taxations? Over.
Generally, yes. And again, I try to keep this apolitical, let people do their own research. But generally, as a matter of policy, as a matter of public policy, one party believes in low taxes and another party believes in high taxes. And high taxes simply mean that they want to be able to provide those social services, where the other states, one party believes that individuals should take care of themselves. So it's just a difference of philosophy. And so normally you're going to pay high taxes or low taxes based upon a party's affiliation and then who's in power. That's kind of how that works. And we're going to cover that later on.
Hey,
That's a good point. That's a good point, though.
I didn't want to get too political, but
Right.
I just wanted to know, did that have anything to do with it? Or
Generally, yes.
as far
Generally,
as like, region of location, like, because out in California, everybody want to be in California, but then I turn around and I look down in Florida, and Florida is like the lowest one on there.
yeah, people move to like Alaska, Hawaii, Texas, because they know they have no income taxes. So that's always a good thing. So, but generally that has something to do with it. And we're going to kind of cover that a little bit later, but that makes a good point. And the map is an idea just trying to show you how it varies per region or vary by state, depending upon where you stay at.
hey, Deke, before we move beyond this, and if you're gonna cover it later, that's fine. But to go along with Brother Clark's question, so when people begin to move from those high taxation states to the low taxation states, will that change? You know what I mean? Them being in those low taxation states, will that change the taxation for that particular state?
Generally, sir, that's a good question. And I'm gonna answer it here. Generally,
Okay.
taxes normally go up when that happens. in that
Okay.
state.
Okay.
And the reason why taxes go up because those states, the ideology is to provide a large safety net for their people. So when people move out, then there's less people paying taxes. So in order to provide those same services, you have to do what? You
Tax
have to
more.
tax those people more that live in those states.
Right.
Okay.
But
That's
the
a good
states that
point.
the state that they have moved to, does that do anything to their taxes?
No, because when they move to that state, then they fall within the state as far as taxes. Just say I moved from New York at 10.9% as an income tax, not federal, but income tax. Then if I move to Texas, then I won't pay any federal income tax. I mean, not federal, no,
Okay.
state income tax. I'm sorry. If I move from New York to Texas, I won't pay any state income tax. So
Roger.
once I
Okay.
change my state of residence, New York no longer applies to me as far as taxes, state taxes. But the remaining people
Right.
in New York then would have to pay more taxes in order to continue to provide those same levels.
To maintain. Right.
So it's kind of like a spiral.
Okay.
It's kind of like a spiral that
Yeah.
you know, once you start doing that, and the only thing that normally changed that trajectory is to change parties, where then they start lowering the tax base, which then starts to lower the amount of services that are being rendered. That makes
Okay.
sense?
I think that's what I was getting at more. Could the party change when people from one state move, more people from one state move to another state?
Yes.
Okay.
Okay. Good.
Tracking.
Anybody else? Good point. All right, I'm not gonna go over a whole lot of it, but just kind of want to hit some highlights from the history, just so you're aware of it. I want to hit the first one. Of course, the first United States federal income tax was levied during the Civil War, and based upon an earlier slide that we talked about, what would be the reason to have a federal income tax during the Civil War? Just it should be real quick. To do what? Remember the purpose of the taxes. What would be the main reason to have an income tax during the Civil War?
To pay for it.
To pay for it. Absolutely. I mean, it's not a trick question. The reason why you have, again, before that time, you had no standing federal income tax that you were paying. They would do it during the Revolutionary War. They collected taxes, but then they stopped. Okay. So, but during the Civil War is when you get the first federal income tax that was nationwide. And of course, it was to pay for the war. That makes sense. And then in 1872, so 1862, you had the taxes, and then it was 3%. Can you believe that, guys and ladies? 3% in 1862, for $600 to $10,000, and then it was 5% after that. When you're after first 10,000, it was 5% for taxes, percent wise. And then 10 years later, once the war was over, guess what? It went away. Okay. And then they made a court come back in 1884, but it was ruled unconstitutional. And then here you go. They passed in 1813 the federal income tax in the 16th Amendment, giving Congress authority to collect taxes from then on. And since then, and again, nothing was going on during the time, but they got it passed through Congress, and now that works. The law gets passed and ratified as part of the Constitution. And then, so now this is what you have. Okay, 16th Amendment gives the Congress authority to collect income taxes every year. And that's why you really won't see any more, and say you will rarely find an amendment to the Constitution, I believe, probably in my lifetime, okay, because of the process that's required in order to get an amendment passed, okay? And you can look that up on your own. I'm not gonna cover that, but it's a lengthy process. And 1943, Current Tax Payment Act made it easier to collect the tax. And this is what we all know today. In 1943, it allowed the employers to withhold taxes from your pay and send it straight to the IRS. It happened in 1943. So this is kind of a young thing that's been happening. In 1853, the IRS was established, where the name was changed. And then in 1875, Tax Reduction Act allowed the use of earned income credit for people who had children. Okay, so you see a lot of this stuff is fairly new. It's not an old system as far as collecting taxes. And this is a different type of taxes. And I'm just gonna highlight. I'm just gonna go over them. and just highlight the one that really affects us as investors, okay? Income tax, we already know what that is. Corporate tax is different. It's a different tax rate. Right now it's 37%, and it is imposed upon businesses on the profits of businesses. So individual income taxes for you as individuals, corporate taxes for businesses. That's the bottom line, corporate tax. What affects you and I the most is capital gains tax. And that's what I want to make sure that you and I understand. It is imposed on the capital gains or profits made by people or businesses from the sale of certain assets, including stocks, bonds, or real estate. Now, like every time you have an election going on, y'all will hear them say that Warren Buffett pays a less tax rate than his secretary. I know you probably heard that plenty of times. All right. But capital gains, you got to understand, has already been taxed as income before. Let's say here in Chapman McCall, you get paid from the Army. You then pay income taxes on that money you already have. All right. Then you decide to buy stocks and bonds or real estate as capital gains. Now that money is taxed again at a different rate. All right. And so they talking about when they say Warren Buffett paying this money in secretary, we're going to cover the rates. You'll see that that's kind of an ingenuous statement or disgenuous statement in the sense that you've already paid money on it at the income tax level, and now you're paying taxes on it again at the capital gains rate. All right. So that's why you got to be careful when you hear stuff like that. That's why I got to highlight it. That's the one that affects you as an investor, capital gains. Okay. The inheritance tax or the death tax is on people who die and leave anything to their descendants, okay, or whoever's going to inherit their estate. Now, one party wants to get rid of that. One party wants to keep that, okay? I'll let you decide which is better. So you have income tax on you when you're living, capital gains tax when you make money, and then when you leave money, one party wants to take nearly 50%, 45%, 45% of your money when you die, so that when you leave it.
Democrats. Democrats.
Okay, thank you. Trying to get it back. Thanks, Kelvin. Can you hear me at all, though?
Yeah, we can hear you. I mean,
Okay.
I can hear you.
Okay.
I said Democrats.
Yeah. All right. I'm just saying. So, I mean, I'm just 45%. Just say you left $1 million to your children, and then they want 450,000 of that right off the top. Okay, as part of the death tax. So just gotta be mindful of those things are there. Kelvin mentioned earlier about local governments, property taxes. We all pay those. It's based upon your land value. And so really, my sister brought this up before, my sister Ruth, you really never own land, because if you don't pay the property taxes, that's what's gonna happen. They're gonna kick you off. So, and then the last one is the sales tax, which includes VAT taxes, which you see in Europe, goods and service taxes, and state sales taxes, and excise tax, basically known as a sin tax. And those are tax on things like cigarettes, alcohol, and stuff like that. So that's why you hear that word sin tax. That's what that means. All right, here just kind of showing the sources of income for the federal government. And you can see where the two biggest ones are income taxes and payroll taxes. Okay. So any question about the sources of taxes?
Hey, Dick, this isn't it's on the previous slide question.
I'm going back.
Yeah. Okay. Aren't there ways to kind of get around some of this, like trust funds and
absolutely.
You know, moving it to a what is it, 10, you know, when you sell a property, taking those capital gains to put it in something else kind of thing. I forget what that's called.
Without more specific information, sir, I won't be able to, but there are ways to do that for tax shelters. But do the average person know how to do that? That's the question, sir.
Oh, no, of course not.
So if you don't know that, then what's going to happen when you die and you're building this wealth for your children or whoever you're leaving it for, your spouse, then what's going to happen is they're going to take that off the top, and you're going to be like, what happened? And this is what's going to happen. So yeah, but you are right. There are ways to hide money especially like a lot of corporations, they move they businesses offshore. I'm gonna go here next slide, sir. Just kind of show
No,
what I'm talking
go
about.
ahead. Yeah, go ahead.
Okay, look at the corporate income tax, 9%. Now, why do you think that's so low? And I go back to your question, sir, what
They
you were
get it.
saying. That it's low
It's like a
because
tax break, don't they?
well, it's low because you got a bunch of tax breaks, one, and two, companies are smart enough to move their headquarters offshore in countries. Let me give you an example. You have Americans, we charge 37% corporate tax rate here in the United States, all right? In Canada, they charge 25%, all right? Because of NAFTA, in Mexico, Canada, United States, I can move goods and services across the border without any taxes, okay? So with that said, if I had a business, IBM, I'm gonna headquarter my business in Canada and not the United States. That makes sense?
Yeah, that makes sense.
So why pay 37%, you
Yep.
pay 25%? So when people say they're gonna tax the rich, you guys gotta be careful, because what that means is, for you and I, is that corporations are smart enough to move their money offshore. Remember the whole state income tax, different places? What happens then when they move their money out? So just the government, the federal government, they do their budget and they plan that $3.2 trillion based upon corporate taxes also. Well, when the corporate people don't pay their taxes because they move their headquarters overseas, they've already promised these things to all these individuals. Guess what they got to do now? They got to raise taxes on the middle class. So just got to be aware. Same thing at the state level. The same thing happens at the federal level. When they promise these goodies, they got to now make good on them. So they raise the tax on the middle class without you knowing it. Okay, and we're going to cover a PE to show you how they kind of hide that to make sure. Okay. Capital gains taxes for you right now, just so that you'll know, is no tax for anything up to $41,675, and that for anybody that's probably on our group right now, you make over that in your income per year. So you're going to be paying capital gains tax for anything that you make. Okay, from 41,000 to almost a half a million is 15%, and then anything over a half a million basically is 20%. I have the exact numbers, but just basically remember 41,000, there's no income tax, no capital gains tax. 41 to half a million, 15%, and over that is 20%. Okay. All right. We almost to the PEs, payroll taxes. You can see here the 1937, the FICA law was passed, and that required companies to withhold Social Security and Medicare from your pay. But the employers, though, must also pay a matching amount, whatever they withhold, send directly to the federal government. Okay. All right. Corporate taxes, you know what that is already. Excise tax, we already covered that. I just want to go back down to the bottom of the et cetera. It's fuel, airline tickets, the Affordable Care Act, tobacco, alcohol, cannabis, and et cetera. Those are some things that I use. All right. Going here now to options and brackets. When it gets there, okay, everybody see the options and brackets? And this is getting pretty close when we get started here. There's two options here when it comes to taxes that is widely considered, okay? I'm just gonna throw out the first one is a flat tax. A flat tax simply means that for us who are Christians, a flat tax will be the same as a tithe. No matter how much you make, 100,000, 200,000, a million, you pay 10% as a Christian. That's your tax, okay, or tithe, 10%. That's a flat. That would be equivalent to a flat tax. A progressive tax is what we use in the United States. As taxable income increases, it's taxed at a higher rate, okay, and we call those brackets. All right, so just kind of understand how that works. Currently, there are 7 federal income tax brackets. All right. As of last year, you can see the brackets here and how they break down. And what I want to highlight is that those brackets, they change, which a lot of people don't know, depending upon, guess what? what do you think changes the brackets?
Your income.
Income.
Interest, the interest rate.
Well, I'm
Go ahead,
saying
man.
generally though, what do you think generally drives those brackets? I don't want to say 7 because sometimes it's been higher. It's been 9 brackets. Sometimes it's been high as 12. But what do you think affects the brackets themselves? Take a one wild guess.
Who's in office?
Absolutely. Absolutely. Who's in power normally dictates the bracket. Okay. So when you hear that whole term, there are 7 brackets. Don't get caught unawares. Okay. I got the asterisk on number 37 because that's the highest bracket right now, but it has been as anybody want to take a one wild guess at how high it has been?
$42.
Okay, that's a good guess. 45% was as high as it was back in 2014, but it has been as high as 92% in the 1950s. All right, you understand what that means? The government taking 92 cents out of every $100 at the top marginal rate. Okay, so I just want you to understand that the brackets are changing within power, and the bracket depends upon your taxable income, of course, and your filing status of that. But just be wary of the brackets. Understand that that changes who's in power. And recently it was 9, it flattened to 7, which is what it is now. And you can see the rates here. All right. And before we get to the PE, did everybody get a copy of the tax rates? I don't think people on the give me a minute here.
I didn't get a copy of it.
I
I didn't either.
copy, Kevin. Let me send you a copy of the tax tables. I sent everybody on CIG on Messenger got a copy of the tax table. I didn't get Kelvin, the people in Group Me, a copy. And I send it to you now, Kelvin. But here you can see in 1913, look at the tax rates from 1 to 7. But now the bottom rate is what? 10%. All right. So again, it changes based upon who's in power. I wish it was back in 1913 tax rates. Okay. And that goes again by the more stuff you promise, the more stuff you got to collect money for, which in the past, it was normally collected for what? Wars and how to pay for wars. Okay. All right. Do you have it yet, Kelvin? I want to make sure I cover it to you. Make sure Kelvin got the copy.
Yes, I got it now.
D, when did you send it in the messenger? Because I didn't see it.
Okay, it should. If you got Messenger, it should be. Scroll up a little bit at 9:52. It should be called Zoom Call 2022 Tax Tables.
I'll look for it. Go ahead.
Okay. All right. This is why this is important. This is gonna be part of your PE. That's why I want to make sure everybody got a copy of the tax table. This is how it breaks out your tax brackets. Okay, and it's based upon how much money you make. And I'm just gonna look at 10%. The income, your taxable income from $0 to $10,275. You owe 10% of the taxable income from that. Now, of course, there are certain things that change or determine your taxable income. One is your deductions, the children you have, or the deductions as far as you filed as single versus married. Those things have a direct impact upon your taxable income. So your taxable income may be $10,275, but by the time you do all your deductions for children and all that kind of stuff, you may end up owing 0 taxes. Okay, so this is just a straight bracket, assuming you have no deductions, and so most of us then fall within that. Okay. All right, so that's the kind of the key part, and most of us probably fall within about the first 5 brackets, maybe 6. Okay, and so by looking at that, you should be able to calculate your taxes based upon that. Okay, and getting pretty close to the PE, so let's do some fun, do some math. Okay, And it's not required, but it's just kind of fun to make sure you understand this, to be able to understand that, again, when they talk about tax rate, it affects your personal income. Okay, that's the key. And again, investing is all about your money. All right. Now you see the difference between single right here and then the married. And the married and single, you can see the differences in the amount of money that's included within the bracket. Okay, so this is using one for married, filing joint, but you have other brackets. This is basically the two main brackets. Okay. Okay. Any questions about the brackets? Everybody knows kind of how the standard work. So using that, then this is going to be, talk you through a couple and then let you do a couple on your own. Okay. This is the marginal tax rate for somebody who's married, MFJ, married filing jointly, and they make $100,000 a year. Okay. Who makes what? That's irrelevant for our discussion. Just understanding that if you file a married filing joint, it's a total income. So we know then our first $20,550 is taxed at 10%. That gives us the taxes for that amount of money of $2,055. Your earnings, the next $63,000 is taxed at 12%. That tax rate give you $7,560. Your last $16,450 is taxed at 22. Okay, and that gives you a tax rate on that of $3,619, which is a total of $13,234 in taxes. All right. Going down below the gray line, that gives you an average tax rate, or you may hear the term effective tax rate. They mean the same thing. Average tax rate, effective tax rate means the same thing. You take the amount of taxes, which is the total taxes, $13,234, and you divide it by your annual income of $100,000 in this case, and that gives you a percentage, which is 13.23%. Okay, that's your effective or average tax rate. That's important. Your marginal tax rate simply means all income above your basic rate at the highest rate. So when you hear the term marginal tax rate for a person making $100,000, their marginal tax rate is $22,000. That's the income that it'd be taxed at that rate for all additional income until they change brackets again. That's kind of quick. Anybody got any questions or comments or questions on how to figure that out?
Okay, yeah, I got one. So say that last one about the marginal tax. You said I can read the all income above basic rate, but that's above the basic rate after they subtract the 1323, right?
No, that means that anything above that 89, what is it? 83,550. So all income above 83, which is the 20,550 plus the 63,000, that anything above that would be at the 22% rate, unless a person change again. You know what I'm saying? Remember the table I just sent you? Remember the table I sent you is 22,000 for anything up to 89,075. I'm sorry, take that back. 178,150. So anything between 89, okay, I'm sorry, 83,551 and 178,150 is going to be at the 22% rate, which is the marginal. Marginal means the highest rate you're going to pay taxes at until you change brackets. So anything being over 178,150, you're going to be at the 24%. And then that will become your new marginal tax rate.
Okay.
It's the easy way to me to kind of explain it would be the highest rate that you're going to be paying until you change brackets. And I'm gonna go back one, and you see here at the 22% rate, all income then between 83,551 and 178,150 is taxed at 22%. All right. So using this example, going back to our screen again, then anything between that and less than 178,150 is going to be at the 22% rate. Okay.
So before we move forward, Deke, let me, could we just say this person's making they're making $100,000 jointly and times 22%, that's how much they're going to be paying?
No, sir. No, sir.
Okay.
No,
All right.
no, sir. And the
Got it.
reason why,
Okay.
that's not correct, because remember, the first 20,550 is not at 22%. It's only at 10%.
Okay. Okay.
So that's
Okay.
why you got to understand the bracket, so that when you figure out each one of these levels, your total tax for that is 13,334. That's why when you divide the 13,234 by 100,000, that's why you get your average rate or your effective tax rate of 13.23.
Okay.
But it's important to
So-
understand your marginal rate, because all additional income, whatever, just say you worked at McDonald's to add to your $100,000, it's going to be taxed at that 22% rate.
Got it. Now I'm getting, so if a person was making $101,000, that 1,000 would be taxed at 22%.
Exactly. Absolutely.
Okay.
Absolutely.
Okay.
So
Okay.
at some point, it becomes a point of diminishing returns of earning additional income, unless you're going to change brackets.
Okay.
That makes sense? So
Yeah,
just say,
that'll hurt you.
I'm earning money.
Ah,
Just say I'm earning money and I'm earning up to 178,
Yikes.
150. I would then tell whoever, as a joint person, you would tell that person then, if you at the rate of, I'm going back one, just a minute. Just say I'm at 22% and I'm making we as a couple making 178, 150. You wouldn't want to make 178, 151. Because now you're at 24% of all income above that. Every dollar at 24%. So understanding the rates then lets you know, unless you're going to jump in it big time. You know what I'm saying? If you're going to jump in at 24%, maybe making 200,000, that's a good deal. But 178, 151, every dollar is at 24%.
It's going to hurt you.
Yes, it's going to hurt you. So that's why you got to, so if you can stay underneath that rate, if you stay on the high end and underneath it, it's better than going to the next. Unless you're going to go significantly into the next. Okay. And I know you say like, well, I don't make that kind of money right now, but your goal is to do that by investing. And so you look here at 37%, any money over that amount, 647, is at 37%. One party wants that number to be at 45. And they want to spread the brackets out. So one party want to keep the low rate at 10 and 12 for the people who don't make a lot of money, 83, 550, we call the middle class. But then they want to make the rates at 22 and above higher. You understand? They want the 22% to be at 30 and then 36. You understand? And then higher rate to be at 45.
Yeah.
Okay. So the people who on the bottom end, 10 and 12%, you're like, hey, I'm not affected by this. Who cares? But if you are investing, though, it makes a big difference. Okay. Now, so that's that. But I'm gonna do one more, and then we're gonna let you kind of work. Make sure we all understand this first, though, and before we move on. We good? All right. Here go one more before you take it. All right. Here's a person now making 125,000. Okay. And again, you see the first 10% is still the same on 25,550, 63,000, 12%. But now you see the tax now of any money, that other 25,000 they made now is costing them significantly in taxes. Now they're paying $9,000 on that. Okay. All right. So let me see. Look, I think I need to give me just a minute here. Just a minute. I think I didn't. Okay. Okay. All right. Let me get back to sharing. All right, we're back in. All right. Okay. Am I with me? All right. So you see here at the 25,000, at 100,000, that person was only paying 13,000. Okay. And then when you go here, they're paying 18. Okay, so you see they paid almost $5,000 more dollars for only earning 25,000 more. Okay, and now you see the rate went up to 14.99%, but the marginal tax rate stays the same. Okay. Questions? No questions? All right, ready for the
I
first
don't think
PE?
I don't think so. Not for me right now.
Okay, ready for the first PE. We're talking about a single person now, person who's single. All right, and the annual income is $50,000. Go for it. And I'm just gonna go back to the tax table for you for those who don't have it. Okay, I'm just gonna go back to that for a single.
22%.
It'll take a few minutes just to kind of go over it. Somebody, when a couple of y'all are done, then just let me know. What I'm looking for is what is the total taxes? What's the breakdown of earnings? What's the total taxes? What's the taxes and total taxes? What's the average tax rate? And what's the marginal tax rate? Those are the 4 key things. Earning breakdown, taxes breakdown, total taxes, tax rate, and marginal tax rate.
So the tax rate would be 22%. Taxable income 41,776 to 89,075 with 48,0750 for
what?
the tax.
No.
Plus 22% of anything over 41,775.
Okay. Anybody else want to chime in before we move on? All right, so let's work it out then. All right, so want to talk us through it, Kelvin? You want to talk us through it,
They had
Kelvin?
to put that at 40, 50.
All right, so you're going so the
So
single
you
tax
got-
rate. So the first 10,075 is what?
Is 2,000.
Right. So your first
One, yeah,
So your first one gonna be taxed at what percent? Your first 10,
at 10%.
10,275
At 10%.
at
At
10%.
10%.
That's gonna give you that, right?
Right.
And then
Which
you
is
have
1028.
right. And so then you know your next one is gonna be what?
12%.
All right. So you're gonna have
Which is 40.
so you gotta do your next what? 40. So you gotta take the next what? You gotta take your next 41.
41, 775
and minus what? 10,275.
minus the, yep,
And that'll give you
minus the
3150.
22%.
That's 3150. Right?
Right.
All right. And then the last amount would be your 41, 50,000 minus 4171, right? So you're gonna be 41, 50,000 rather,
41, 775.
minus 41,775. All right. And so your first rate is going to be 10%, then 12%, and then 22%.
And 22.
All right. All right, so is that what you got?
Yep, average rate 13, margin of 22.
All right,
Because the marginal always going to be 22.
okay. All right, did everybody get the same thing? If you don't, that's what we're trying to make sure that it's important that you kind of understand how to calculate. So a person as be the tax rate of a person who's making $50,000 a year.
Makes $50,000.
A year, you're paying a $6,000 taxes. So all things being equal, with no deductions, okay? All things being equal, if a person, all things being equal, if a person was able to add that back in there into their paycheck, they would take what? The tax rate, which is what? Tax rate, which is $6,666.17. And they can divide that by 12, and they'll be able to add that money back into their check. Another $551 back in their check per month.
Yep.
Right?
Right.
Yeah. So that's kind of what this exercise is about. The understanding that your tax that you pay has a direct impact upon your take-home pay. Okay. All right. Okay. Now here's number 2. Oh, I almost gave it away. Number 2, you're making $175,000 married filing joint. Same exercise. Anybody close? Okay, we're gonna go ahead and move on. You should be, if you're on the right track, that's where you should be at, if you're on the right track. Okay, because I need to get to the rest of it. All right, you should be, that's where you should be close to. Remember, it's going to be a different tax table for married, joint versus single. And I'm going to go ahead and give you the last one. All right, so we can cover the rest. I want to get the rest of it before my time run out. Okay, and think if you're making over 210,000, that's where you would be. Okay. So the key exercise here is understanding that the tax brackets understand that as you are earning more income, you want to, if you're going to break the next bracket, make sure that you do that significantly and not by a few dollars, because it hurts you when that happens. Okay.
So Deep, when you say significantly, in your mind, what's the price range of significantly? Like, where does it start?
For me, I would say at least 25% within the next bracket. So
Okay.
so just say if the bracket was $100,000 that was covered, and remember the ranges are different, so it's not like a set. So I use percentage most of the time. So if the bracket was $100,000, you would not want to, in my mind, until you got $25,000 more dollars, you wouldn't want to try to go up to that next bracket. And you kind of control that based upon, again, we're talking about investment. A lot of this is talking about investment, that you can wait to make that purchase until then. You understand?
Right.
Or you might decide this is an opportunity for me to invest in stocks that don't pay dividends, because you don't pay stocks. Remember, when you sell a stock, you have to pay a capital gains tax. If you just own the stock and it doesn't pay any dividends, then you don't pay any taxes on that income until you actually sell it. That makes sense? So you may decide, for instance, I don't want to buy Coca-Cola. I might want to buy Tesla instead, which doesn't pay dividends. So you will be earning more money on that end, and then you may decide I want to sell Tesla and then move to Coke once you have enough money to take you over than 25% over that bracket. That makes sense? So this is really more for investing, to understand timing, when is the best time to make investments and which type of investments that I want to get or invest in. Okay. I mean, because you can be moving $50,000 to $100,000 within a month. You know what I mean? So if that's happening, you want to make sure then that you're getting the right type of stock mix that's not going to take you barely over to the next table, and then all those dollars are taxed at that level. Okay.
Tracking.
All right, then. Moving on. Key more terms you're probably hearing right now, and please feel free to jump in. This term is inflation. You're probably hearing that word inflation. It's the highest it has been in 50 years, approaching the highest it's ever been, but it's right now the highest in 50 years. And that's a bold-faced increase in prices of goods and services over time. I'm going to break it down to how I learned it. It is too many dollars chasing too few goods. Okay, that's kind of the easiest way to kind of remember what inflation is. So in other words, if I got 10 people with $1,000 and I only have one car for 1,000, they all can afford that car, right? Right?
Right.
So what I do then, I raise the price of the car to now 2,000. Well, those 10 people with 1,000 can't afford it. So they got a choice. They can either go without the car, or they can put their money together, two of them at a time, and get the car together. Okay? So inflation, it is too many dollars. More people got money than there are goods. Okay? And so what happens is then naturally prices are going to go up in order to ensure that not everybody can afford those goods. I can't keep up with that. So what I have to do is then raise the price. That makes sense?
Correct.
Makes sense.
I mean, you can't look at it like, you got to look at it in the business sense. In the business sense, I only got one car. And in business, what you try to do is maximize your profits, right? Okay, so what do? Then, and let me use another example. I know it was unpopular to do Hurricane Katrina. Unpopular again. You can't look at moral versus business. Okay, two different things. Business, I'm going to maximize profit. In Katrina, the price of water went up. Okay, one, I had to truck it down there, and the people did not have it. So what I can do then, if I'm in the water business, I can sell my water for more than I normally would. Okay, now should you do it? That's a different question. We're not talking about the moral issue. We're talking about the business side. I want to maximize my profit. So instead of selling a bottle of water for $1, I can sell it for $5. Because the people have to have the water, and I have the water, so I can sell it for what I want, right? All right.
Right.
So that's what inflation is. So that's what's going on right now. Remember, we are a petroleum-based economy. So meaning gas, oil, coal, all of that economy. So a fossil fuel economy. So with that said, energy is included in everything that we do. From the farmers who have to put diesel in their tractors, to the truckers who have to move the goods from state to state, and to for us who have to put fuel in our car in order to go back and forth to work and some that kind of thing. So when fuel goes up, everything goes up. Okay, because I got to charge you more now. I can't charge you the same price. I got to charge you more now because remember, everybody has money, but there's a limited amount of goods. So I got to raise the prices in order for me not to be out of my goods. You understand? So that's how that works. These are some of the causes of inflation under the bottom. Pressures on the supply or demand side of the economy. In this case, we know where the problem is at. It's on both sides. One, there's not, because of COVID, there's not enough people who's making those goods. It'll take them time to catch up. And then with all those stimulus checks and all of those large omnibus bills that were passed, people just got money sitting around now. So a lot of people got money, and it's not a lot of things on the shelf because COVID shut down and people were not producing, people not going back to work. So the supply and demand side of the economy is affected. Money supply policies. We were just giving out money, especially during COVID. Everybody know it. We just, was it PPP loan? People giving money to keep their employees, and unemployment was extended over and over and over again. So now that it's over, people got money, but there's no goods. So you got to raise the prices on things to stop inflation. And consumer expectations. Right now, consumer expectations, people are not positive about the economy, okay? And so what happens is people hoard the money, which is a good thing, but they have it, and so prices go up. First of all, does it make sense? And two, any comments? Okay, no comments. Okay, what's one thing then that could bring down inflation based upon what you already know?
More supply?
Okay, more supply would be good. Okay, now is that going to take time, you think, or what?
Yes.
Yes, it'll take time to ramp up in order to get those things that we want now. It's going to take time for that to ramp up. Okay, so that's one thing that can do it. Another thing that you and I both know that can happen is that money supply policies. What is the Fed doing right now to help curb inflation?
Raising the interest rate.
Absolutely, raising the interest rate. What they're trying to do on the Fed side is, again, we got more people with money than we have goods. So the Feds are going to keep raising interest rates 0.25% or quarter basis points at a time to price some people out of the market. That makes sense? And use gasoline again as an example.
Yes.
At what point then would it force you to stop driving and park your car? There is a point that would happen. Okay.
When it get to $20 a gallon.
Okay. You see what I'm saying? So the Fed's going to keep raising rates, which make it more expensive for all things, and therefore, at some point, it's going to slow down people's demand for things because you're not going to be able to afford it. That makes sense? So that's the purpose of raising your interest rates, is to keep raising it to a point where when you borrow money, it becomes so expensive you can't afford to pay back, so you just don't borrow anymore. So supply, that takes care of the supply and demand side. The Fed takes care of the money supply side. And so anytime Congress talking about passing these more, they're talking about trying to spend another $1.2 trillion. Not a good idea. Not a good idea. Because there's already too much money in the economy right now that's not being used, okay? And the last thing is consumer expectations. That's not going to change until when? Now, the consumer expectation part is what's depressing the stock market. People are not confident in what's going on in policy. So what do? They sell their stocks because they're panicked.
Yeah.
Now, there's nothing wrong with the company Apple. So me personally, I'm buying more Apple while it's down. But because people are fearful of the policies is the reason why people are selling right now. So for you, that's not going to change until November, maybe, okay? And if it doesn't change then, it won't change in 2024. So inflation going to be around to at least November or at least to 2024. All right, so you can expect this environment to stay in the near term, okay? Any comment on that? All right, now deflation is just the opposite of inflation. Inflation, you had too much money chasing too few goods. Deflation is when you overproduced, have way more goods than you need, and you don't have enough money. All right, so that's just the opposite of that. We want to people don't complain about deflation, so I'm not going to cover that because deflation is a good thing. You got more supplies. Then what's going to normally happen when you got more supply than you have money? What's going to happen is price is going to decrease. Okay, so that's a good thing. All right. Any question about deflation? All right. We put this out some time ago.
Hey,
Go ahead, sir. Go ahead. No, jump in.
With deflation, how do we, what are some of the signs of that? So because it sounds like deflation is the time to start buying, maybe? Or is that the time to start selling?
That's the time you want to start selling. Why?
Okay, got it.
Why?
Okay.
Because you got an abundance of goods, but not enough money circulating. So
okay,
people who get all the bargains gonna be people with the what? Who got money. Right?
Right.
Yeah.
Right.
Yeah, so that's why people are in the market right now during the inflationary time, they're selling everything because they're panicking. So when there's deflation, people are buying more. Okay. So that's when you want to get in and really buy when there's deflation, because only people who are going to be able to buy anything are people who got the money. Okay. That's a good point.
Correct.
That's a good point. I remember
right now.
Go ahead.
So right now, should we be putting away and stacking for deflation?
Absolutely.
Waiting.
Absolutely.
Okay.
Except for, that's the people who are just earning money, who live in day to day. If for people who are investors, though, I'm grabbing mine now because people have sold off their stocks. During deflation, guess what's going to happen with stocks during deflation?
They're going to go up.
Exactly.
You ain't going to be able to afford it.
Huh? Remember, because
yeah,
right, exactly. So during inflation, people are sold off. So companies like Apple and Microsoft, I'm getting for $220, $215. When deflation comes around, them same stock will probably be around 3 something.
Got it.
Yeah. Okay. So you look at the definition. While a slight decrease in prices may spur consumer spending, broad deflation can discourage spending and lead to even greater deflation economic term, which causes a downturn because remember, the federal government relies upon payroll taxes, and people not working, guess what's going to happen? There's no payroll tax. I mean, not no payroll tax, but it's reduced when people are unemployed. That makes sense. You know what I mean? People not working, you're not getting that income coming in. All right. All right. We put this out some time ago, and we talked about making sure that we all understood how this worked. And as you as an investor, you got to absolutely be able to explain this. All right. Supply and demand, they are interrelated, okay? And this is used in the case of gasoline. People was wondering why gas is going up, why is it going down? We're gonna try to explain some of that real quick here. If you look at the chart on the left-hand side, you see at $1.40, okay? If you move to your right, you see a point where it's called equilibrium price. And you go down, you see here that is 600 million gallons of gasoline, okay? So at $1.40, $600 million gallons of gasoline is the perfect price, which means that people are willing, you get the most people willing to pay $1.40, and all you want to produce is 600 million barrels of gallons of gasoline. That makes sense? First of all, PE, it's called price equilibrium or equilibrium price, okay? All right, that makes sense? If you raise the price of the gasoline, let's say up on the left-hand side to $1.80, how much do you think producers are going to produce? And that question
You're gonna want to produce like 500 gallons.
500 gallons of gasoline. Why? Because when prices go up, then people use less of it, or the demand goes down. You understand? The demand gonna go down when people have to pay more for something. So at price equilibrium, $1.40, I'm gonna sell all my 600 gallons of gasoline. If I produce 600 gallons of gasoline still at $1.80, then I'm gonna have excess supply on hand because people are not gonna buy it at the same rate. So at $1.80, I'm only gonna be able to sell 500 million gallons of gasoline. That makes sense? That makes sense though, that as gas goes up, fewer people are gonna either take trips or they're gonna modify their driving habits or things like that. That makes sense?
Yes.
Yeah,
Don't make sense? Don't make sense?
No,
Okay.
no, that makes, well, it makes sense to me. I understand that.
Okay. And on the other side of the aisle, if I reduce my price to $1.20 using the same chart, then you go over, you're going to see that is 700 million. I'm gonna sell more of it, but it's going to be at a cheaper price. So that price point then is going to be 7. It means to get the same amount of money, I have to produce 700 million gallons of gasoline. I got to produce more at a lower price. So people ask the question then, as prices go up, why won't the oil and gas company produce more oil and gas? And you would tell them what?
It'll be an overabundance for me to produce that much fuel when I can only sell it for a lesser price.
Right.
I won't make as much money. I won't make money off of it.
I know people get upset about this, but again, as an investor, businesses are in business to make money, okay, profit. And so I'm not going to produce 700 or million gallons of gasoline at a higher price because the same amount of people can afford it. They mean they're not going to buy it. So demand is going to go down. So I'm going to reduce how much drilling I'm doing in order to keep my profits the same. That makes sense?
To me, it does.
Yes.
Yeah,
Yes.
I need to make sure, this one is the charge that I need to make sure we get a yay on from everybody out there, because it's very important. Because a lot of people can't explain to me, well, why is gas prices going down? Why are they going up? And again, PE is the price that gas should be. But when something is affected like supply and demand, it causes prices to change. Okay, so first of all, we make sure we get a yay and nay on everybody, and then I'm gonna give you the reason why this is changing. So, Captain McCall, we good, sir?
So I'm gonna kind of restate it what you said as I'm thinking about it. So at PE, 20 people are buying gas, right?
Okay.
Gas goes up. If I, continue to produce that amount of gas at that higher gas price, well, only 5 people are getting gas. I'm losing money. I got to pay more to produce this gas to keep it, high, but let only a few amount of people, half of that, are going to pay for that gas. Therefore, I'm losing money.
Right.
So in order for me to continue to make profits, I have to produce less gas so that more people can, or at least those 5 that are buying it, they're covering that other 5 that wasn't going to buy it.
Exactly.
Got it.
That's a good point.
Yep.
You got it. Doretha, good?
Tracking you, sir.
Okay, thank you. because that's important because a lot of people don't understand that. Okay, now what I'm going to tell you is that one of the causes of this, okay, and so and there are other causes. I'm going to give you one cause that I know for a fact. Okay, energy policy has an impact on the price of gasoline, and I'm going to tell you how. If you shut down American drillers, or you won't give them permits, then they can't drill for more oil and gas. So therefore, there's less oil and gas on the market as a whole. If I was drilling, use this chart here as an example. Just say I had 600 million gallons of gasoline, I'm making $1.40. But the federal government come in and say, you know what? I hate oil and gas users. I can't stand you guys. Y'all polluting the environment, you know, all that kind of good stuff. And so I'm gonna force you all to drill on fewer drilling permits or drilling places. So now you're only producing 500 million gallons of gasoline. What that does is reduces the amount of oil and gas on the market as a whole. So what's gonna happen to the prices?
Price is gonna go up.
It's gonna go up. Price is gonna go up. And so when as you further reduce the amount of oil and gas on the market, then it's going to happen even more. So you got some causes, Russia, Ukraine. Okay, when that happens, took Russian oil and gas off the market, price is going to go down. Okay, I mean, the price is going to go up. I'm sorry, price is going to go up because you got to reduce demand here in the States. We need. We stopped drilling. We didn't stop drilling, but reduced the amount of federal permits that we use in the States. So in order to go green, that further reduces the amount of gasoline we have in the States. And then, of course, when that happens, then there's not enough gas, but the people still want it because everybody got money. Remember all that money we gave out in stimulus and all that kind of stuff during COVID. So now people got the money and they had the prices is going up, but because people got the money, in a normal time, people wouldn't pay for that. Okay, just say in our example here in price equilibrium, at 180, you got 500 million gallons of gasoline. If you got 400 million gallons of gasoline, it's going to go up even higher to about 220. But at some point, people get priced out the market. But people are not being priced out right now because people got excess money laying around. And that's why you have $4 or $5 a gallon, because people still can pay for it. And so it's not going to go down anytime soon. Okay. We ain't talking about losing, oil and gas from Strategic Petroleum Oil Reserve. That has a short-term effect. Gas price holidays, taxes on gas price, that has a marginal effect. But until you structurally change, like all of the above approach of drilling, nuclear, all of that kind of stuff, then prices are going to stay about where they are for some time. Okay. So just so you know and able to explain it, that it's going to stay that way for some time until energy policy changes. Okay. All right. Next one is, we're almost done. Next one is the recession. And the recession is simply, you probably hear that term being thrown about. That's why I'm covering it. It's a temporary economic decline. And the key here is 2 successive quarters. Okay. So a quarter, of course, is 3-month period. You have 2 of those combined, you're in official recession. Okay. Again, and the main thing for that is understanding it got to be 2. The next one here is a depression, and it is different from a recession in the sense that that it is a major downturn and it affects everything. Bankruptcy, stock market decline, you name it, it affects it all. And the reason why you probably won't see depression probably in our lifetime is because of the Fed monetary policy. They're trying to make sure that we don't hit a depression again. Okay. All right. Okay. Here's the part that I want to get to affects us as investors. Okay. The prime interest rate. Okay. The first time I want to cover, because we didn't cover this in our last class, we didn't have was 70-30. Because we didn't do that, I want to make sure I cover liquidity. Liquidity simply means the ease with which you can turn whatever you have into cash without incurring a loss. Okay, so again, how fast you can get your money, how fast you can turn your money into cash without incurring a loss. And most things other than cash, when you try to get it, there's a penalty that you have to pay in order to get it. I don't care if it's CDs, I don't care if it's stocks, I don't care if it's bonds. If they have not matured yet, you're going to have to pay a penalty in order to get your money, and it normally takes some time. Okay, so understand what liquidity is: cash, fast, without a loss. The banks are tied to what they call the prime rate, prime lending rate, and that's key for you. In every sector is tied to the rate in a different way. Okay, so the Fed will come out and establish the rate. In this case, it's 3.5%. Housing market, the banks, real estate, credit cards, they all tie their lending to the prime lending rate. Okay, now credit cards normally is 15% above prime. Okay, now you can find better rates, but I'm talking about generally. So if the prime rate is 3.5%, which is what it is right now, well, as of March 22, then if you get a credit card and apply for one, then it's going to be what rate?
The prime rate.
If you apply for
3.5.
Yeah, if the prime lending rate is 3.5 and you apply for a credit card, and credit cards are tied to the prime, they normally, it'll be something like 15% over prime. Okay, so in this case of a credit card, it'll be 15% over prime. Prime is 3.5. You probably have a credit card at 15 over prime. 18.5%. That's how that works. So every sector is tied to the prime. Okay, so the housing market may be 2% above prime. So you might be, if the prime is 3.5, it'll be 2% above prime. It'll be 5.5. Okay, and so every industry or every sector is tied to the prime at a different rate. Okay, so just be aware that following the prime is important, even when you get interest rates at the bank. Now the banks, when they give you interest, they would give you just the opposite when they pay you interest. I know that's weird. Okay, but when the banks would tell you, we'll give you 3 points below prime on your, like down below in category D, sub paragraph D, they'll give you 3 points below prime. So if the prime rate is 3.5, your bank is probably going to give you a 0.5% interest rate on your savings account. That makes sense?
For them, it does.
yes.
Yes.
See, for them it does. Again, what they're trying to do is use your money. So you put your money in a savings account, they're using your money. And by using your money, they want to give you a 0.5% of that. Well, again, not 0.5%, but 3 points below prime. So if prime go to 6%, then they'll give you 3.5% of your money. All right. Okay, so the prime is kind of tied to everything. So you and me, people who don't buy things, we want the interest rate to do what?
We want interest rate to go up.
Exactly. Now, I know that hurts.
I know it sounds bad, but we want it to go up.
Yeah, we want it to go up.
Get more money out of it.
And you go, remember, we are investors. Again, when you talk about the moral issues, all this, we're talking about investors. We want the interest rate to go up. Remember, look at the top chart, top part of the chart. What does it say?
Poor people pay interest.
That's right. Wealthy people
And wealthy people receive.
Right.
Yeah.
So I'm just keeping it real. So when you go buy, just say you go buy a car and it's at 10 points above prime. So now you're paying 13.5% for the car. All right. If it goes up, then in your sector, you get paid more money. So therefore, we want to receive interest. Same thing happened in stocks and bonds. You call it dividends, but in stocks, we get dividends, that's interest basically. Okay. So poor people pay it, we want to receive it. Okay, that's our goal. All right, last, that's called a savings account. The high yield savings account or money market accounts. This is part of the 70-30 class. I'm just kind of interjecting it right now to make sure you get a little bit of this also. When you put your money in the savings, it should be divided into thirds. A regular savings, 10%, high yield savings or money market, the other 10%, and then CDs should be the last 10%. Okay. Because remember, we're talking about liquidity. All right. So each one of them has a different level of liquidity, but they all pay different rates. So your regular savings are going to pay lower than your money market or your high yield savings account, and then CDs are going to pay the most within a bank. Okay. And even in CDs, you want to make sure they stagger. All right. So you may want to get like a 6-month CD, a year CD, you know, that kind of things, like staggered, so they all come due at different times. Okay. Everybody got any questions about the prime interest, prime lending rate or interest rates?
No, I don't.
All right.
No.
Okay. And just so you be, just so you know, they're going up. Okay. So anytime you hear it on the news, that's why it's major news. The Fed is raising the interest rate. Okay. Understand for you as an investor what that means for you, that the Fed is raising the interest rate. As a saver, good job. If you're going to be buying something, car, house, credit card, bad. Okay. So the higher it goes up, and that's why the housing market now is starting to tank a little bit, because they raise rates, it becomes more expensive to what? Buy a house. Okay. All right. You guys are on top of it. Okay. Any general Q&A? I know there's a lot. There was a lot that was covered. We're trying to make sure that we, you know, make sure it's self-explanatory, make sure that you can explain it to other investors. And that's kind of the goal. Okay. Got you back on the mainstream. So any kind of questions or comments?
So
or
I do have
clarification?
I got a question. It
Okay.
is, it goes along with what we just talked about. Just class idea. Can we do a class on tax sheltering, right? Things we can do to, you know, shelter some, you know, to avoid some of these things.
Okay. Future class. That's be on the future classes then. Absolutely. Tax shelters. Okay. Got it. Okay. Got it, sir. Any other questions or comments?
I just have a question.
Okay.
On the last slide, you talked about the savings account, and it started to cut off for some reason. But anyway, did you say that you need to invest like a third into a CD, a third into a regular savings account in the high market? Is that how you explain it, or did I misunderstand?
You absolutely got it correct. That's absolutely correct. That whatever money you have in your accounts should be divided in 3 or in thirds.
Okay. Okay. Got
Because
it.
the idea is that they each pay a different interest rate based upon,
Mhm.
you know, in your bank. So you want to get the highest, but at the same time, you got to make sure you watch out for liquidity. Okay. So a regular savings, you can get your money faster than you can a CD, but again, without paying a penalty. Now, you can always cash them in, but you're going to lose that interest if you do on a CD. So a savings account, you generally don't lose anything, but they pay you a very small interest rate for using your money.
Okay. Got it. Thank you.
Yeah. And just a previous class, how much we supposed to have in our account, savings account? Anybody remember? All right. 6 months of your check should be tied up in your savings. Okay. So if you make $5,000 a month, and you're supposed to have $30,000 saved. That's your goal. And that goal of 30,000 then should be 10 in regular savings, 10 in high yield money market, and 10 in CDs. Okay. And then the last 10 should be staggered. Okay. All right. Any other comments before we go cover the last slide, which is just a future classes? The next class is scheduled for 22nd of October at 10 a.m. And we're going to be talking about compounding interest. Okay. Again, understanding compounding interest. All right. No closing questions, comments, nothing. We all good. All right. Well, I want to thank you all for attending. Again, the goal here is to make you all better investors. I hope some of the terms now, when you hear them, that you have a clear understanding what they mean and how to articulate to someone who may be thinking about investing in the future. Okay. All right. Nothing else?
And I just want to say thanks for taking your time out and hosting this class. Appreciate it.
Yep, appreciate you.
Yeah. Thank you. Yes.
And you're
Agreed.
definitely welcome. And because y'all are already on here, as you know, when we do record them, if we have more than one person to show up, we'll do the session. And they're all recorded, and we will put it on the on my cloud. So if you have access to my cloud, you'll be able to see this probably about a half an hour from now. By the time I get it downloaded and uploaded to my cloud, you should be able to see it on my cloud. Okay.
All righty.
All right.
Got it.
Thank you all. Y'all have a blessed day.
Thank
All
you.
right. Thanks.
All right.
Thanks.
Bye-bye.
All right. Brother Clark, good to see you.
Good to see you too, sir.
Yeah, yeah.